Simply given the fact that you're named as a beneficiary to an inheritance means you've lost somebody you love and who obviously cared for you. As if this time isn't hard enough, the laws and rules surrounding an inheritance seem to be increasingly complex. In fact, in recent years, the IRS did a very IRS thing to do and made it even more confusing to inherit a retirement account. Specifically, today we'll address the rules surrounding inherited IRAs. I use the term protect your inheritance to illustrate that as beneficiary, I feel we owe it to the person who left us funds to try and keep as much of it as possible. To simplify our discussion, we'll categorize beneficiaries to two main groups, spouses and non-spouses. After going over the rules for each, we'll then show a powerful example to try and help determine the best time to take the money, as well as ending with some important extra tips. As always, please consult your tax advisor for specific information to your situation. First, spousal beneficiaries. So spouses of the deceased have the option to simply assume the IRA as if it was their own. It's then simply treated as if it was always their own, especially with regard to required minimum distributions, which then apply to their age only. One potential benefit of this is if the deceased spouse was older, the younger spouse actually can wait until their RMD date to start beginning required minimum distributions. Now, there are reasons why a spouse would not want to assume the IRA as their own and would instead want to put those funds into an inherited or beneficiary IRA. For one, if the surviving spouse is older than the deceased spouse, they can actually delay required minimum distributions until the deceased spouse would have hit RMD age. They do this because perhaps they want to limit distributions or push out the tax obligations to the future. Another reason they may want to use an inherited IRA instead of assuming it on their own is if they're not 59 and a half yet, especially if they need immediate funds. So inherited IRAs always avoid the 10% penalty. Assuming the IRA as their own and they needed funds under 59 and a half, they'd be hit with the 10% early withdrawal penalty. The inherited IRA, no such penalty. By and large, the most common choice for the surviving spouse will simply be to assume the IRA as their own. Let's move on to non-spouses. There have been changes over the years with the Secure Act that affect anybody who's inherited an IRA after 2020. The general bottom line is that the funds from an inherited IRA for a non-spouse must be withdrawn from that IRA over 10 years. Again, we'll call that the 10-year rule. Now, only if the rules were that simple. First, the 10-year rule doesn't apply to minor children until they reach age 21, chronically ill or disabled beneficiaries, or non-spouses who are less than 10 years younger than the deceased. All other non-spouse beneficiaries, which is probably the majority, must withdraw the funds over a 10-year period. Why is that? Well, simply that money hasn't been taxed yet, and the IRS wants their cut. So it doesn't matter exactly how much you take out every year, as long as by the end of the 10th year, the money in the inherited IRA is completely exhausted. But if the account owner was already taking required minimum distributions, those RMDs must continue during that 10-year period based on the beneficiary's age, or there'll be significant penalties. Another but is that even that is currently up in the air as the IRS gave relief and no RMD was required in years 2021 through 2023. So stay tuned for 24 and beyond. So let's talk about the 10-year rule and when to take those funds out. Obviously, the timing of those distributions will cause varying tax ramifications depending on one's situation. One argument for waiting the entire 10 years is that 10 years worth of tax-deferred growth will build up before paying taxes. The flip argument, of course, is that waiting until the end could put you in a much higher tax situation. So let's take a look at a quick example and let you decide for yourself. Let's say for this example, a non-spouse was inheriting an IRA worth $1 million. They immediately moved it into an inherited IRA. Their first option is to take that $1 million out immediately and pay all the taxes right away. So that obviously would put them in the highest marginal federal tax bracket of 37%. We'll make some assumptions and assume an effective tax bracket of 30%. That means $300,000 comes out right away and goes to the IRS, and they keep $700,000. Let's assume they invested that money at 6% annual growth rate, in which case that $700,000 will grow to roughly $1.25 million. At that point, they'll pay capital gains of roughly 15%. They'll have paid a total of about $382,000 in total taxes, and net, about $1.168 million at the end of the day. Option 2 is that they let that $1 million grow at the aforementioned 6% for those 10 years. At that point, that $1 million will have grown to roughly $1.8 million, and they'll have to take it out immediately at the end of the 10th year. Again, they're now in the largest marginal tax rate of 37% as of today's tax bracket. They'll also have other income, so we'll assume an effective tax bracket of roughly 33% at that point. They'll then pay about $590,000 to the IRS and keep roughly $1.2 million. The third option is that they take out equal amounts every year for 10 years. They take that money, they invest it at the same 6% growth. Mind you, the IRA is still growing at 6% at the same time, so those distributions aren't going to be exactly $100,000. So what they'll end up taking is roughly $129,000 out per year. Added to their other income, that $129,000 is roughly a 24% marginal tax bracket or 16% effective. So every year of that $129,000, $108,000 goes into their investment portfolio and $21,000 goes to the feds. As they invest that $108,000 every year over 10 years, that grows to roughly $1.5 million. They'll pay capital gains taxes of roughly 15% and end with a net of $1.47 million. So as we can see by this example, taking equal payments over time may certainly be the most efficient way to exhaust that inherited IRA. Now let's move on to some important tips to remember as anyone navigates this process. First, we can't contribute to an inherited IRA. The inherited IRA needs to remain separate from any other IRA. Any required minimum distributions for either must also be kept separate. Second, we can't convert an inherited IRA to a Roth IRA. We can move the inherited IRA to another brokerage firm, but we can't do what's called the 60-day rollover rule. Next, an inherited IRA is QCD eligible. That's qualified charitable distribution. We can move up to $100,000 annually to a charity, and this covers the required minimum distribution. Next, we didn't talk a lot about Roth IRAs. So Roth inherited IRAs do have the 10-year rule and may have required minimum distributions, but certainly waiting as long as possible in a Roth IRA is obviously best because there's no income taxes when the money comes out. As discussed before, inherited IRAs are taxable, but never subject to the 10% early withdrawal penalty. And then always, we need to remember to name a beneficiary for that inherited IRA. Now, this is clearly a very sensitive topic and one that we all eventually face. And we put this concern in our estate and legacy planning section of our 10 most common retirement fears. We've also covered some other items on that list here, as the goal of this channel is to individually address each of those 10. If you've taken even one item from this discussion that becomes helpful, I'm very glad we could help. My name is Shawn Hochuli. Thanks for watching.